Welcome, everyone. Today, my guest is Lead Analyst Logan Mohtashami to talk about the Fed's desire to create a job loss recession at seemingly almost any cost and what that means for mortgage rates. First, here's a word from our sponsor. This is Sarah Wheeler, Editor-in-Chief at HW Media, talking with Melinda Wilner, Chief Operating Officer at UWM, about PA+. Melinda, what is PA+, and why did UWM decide to roll this out?
PA Plus is a new service for us to help loan officers with processing an entire loan. So it takes a lot of time to gather documents, to review them closely. And what we do is we look at initial disclosures. We get documents from the borrower, both upfront and then anything that comes in after the underwriter. We take the loan all the way through closing, schedule that closing date, and get docs out to the borrower and see the entire thing all the way through. So we're excited. It's a great way to help our brokers scale and focus on the things that they do, like growing their business and getting leads and bringing in new customers while we take care of the back end of things.
Great points, Melinda. And listeners, you can find out more at uwm.com. Logan, welcome back to the podcast.
It is wonderful to be here, Sarah, on a glorious Friday PCE inflation day.
Oh my gosh, let's get right into it. Inflation, what are we seeing?
I could safely say now that the Federal Reserve actually lied to all of us last year. And I was a little bit suspicious of them last year on this. And I'm gonna give you my case because I have not been a Fed pivot person until the labor market breaks. And I think the pushback I get on that is that the Federal Reserve has correctly told the marketplace that they're tracking 3-month, 6-month, 12-month core PCE, personal consumption expenditures, that inflationary data. They want that back down to 2%. So under that premise, with their forecast for that data line to come down, the Fed pivot started to pick up steam toward the end of last year. Except I kind of was just like, no, really, they kind of seem like they want to go after the labor market. So I can't prove it until we get a series amount of data that gets to the Fed where they would want to say, okay, we're done. And with where 3-month, 6-month, 12-month core PCE is today, they should easily be saying, we're done. We're no longer hiking. We're gonna stay here and hold rates. But that's not the case. We had Fed people talking about rate hikes coming up next. They were hiking rates during the banking crisis. They said there was no stress in the system, then emergency lending. There's all these things happening on top of core PCE getting to a level that they wanted the Fed funds to be at. And hopefully now people can understand why I wasn't a Fed pivot person and have flat out said they want a job loss recession. They're keep on telling people this, right? We need to attack the labor market, labor market, too much. And we even have 18 months of wage growth cooling down and they don't care, right? So if it was a normal year where there is no debt ceiling issue, there is no banking crisis, the economy is just expanding, okay, but that's not the case. They were still tightening, even knowing that credit was getting tighter before the banking crisis, after the banking crisis, and still talking about it. So hopefully now people can understand was a little bit suspicious of that. And that's why not a Fed pivot person. I think we talked about this in October of last year in a podcast. It just seems to me that the Federal Reserve's old models were, the natural unemployment rate is like near 5%, and wage growth needs to come down, and labor supply is actually the Fed's target. It's not so much core PCE. They believe that we need to create a higher unemployment rate to fight inflation, which is 1970s, and they're sticking to it. And even with all the comments that we've seen just this week, that has been the most consistent theme with the Federal Reserve. And then it explains everything that's happened, in the last 8 months, actually.
So from your perspective, because you have always said that you thought that they wouldn't pivot until jobless claims got to a certain point, right?
Yes. Two things. Jobless claims 4-week moving average. It's always key to say 4-week moving average because you could have like one report have a spike and not get there. But if jobless claims gets above 323,000, then the labor market, the labor market has broke. See, people are used to a Federal Reserve making sure that employment is going well. So it's weird to a lot of people for them to target labor directly. So we're not there yet. Again, we were the only people during the recovery that said job openings are going to get to 10 million. There's a lot of people who do not like the job openings data. They don't believe it's valid, but the Federal Reserve believes in it. So the Federal Reserve does not fear a kind of a job loss recession with job openings at 9.5 million. I think they would feel more comfortable. It's really crazy to say this, but the 2.5 million decline in job openings hasn't created a job loss recession. I think they wanted to get down to 7 million. That's the pre-COVID levels. Wage growth was more acceptable then. So they're really attacking labor and wages. That's the focus. And I think after today's core PCE report, which came in a little bit hotter than expected, but kind of still in that downtrend, and again, over the next 12 months, the shelter aspect kicks in. They might even hike again in the next report. So I was suspicious, and now I think my suspicion was correct. And again, this is why I think if you believe the Fed's not going to pivot, you have to give your reasons why. This is my going back to October, the reasons why, and we're sitting here today. And with all the events that have happened this year, hopefully that emphasizes why I believe they will target labor, not inflation.
So you have said that consistently, and I think you're proven right. So let's talk about, do you think they're right to target labor? Right? So that's you keep saying, well, that's 1970s thinking, but do they have to do that in order to really kill the inflation?
My theme has always been the Federal Reserve. If you want to keep rates higher for longer, you're going to have to endure, which means that if you get the Fed's funds rates to where you thought 3-month, 5 or 6-month, 12-month core PCE is, then you have to let it stay there and just deal with it, right? Go with it. But they're not doing that. They're attacking the labor market because they really believe the best way to fight inflation is the same way in the 1970s, a job loss recession. So my premise would be just to endure and just say, listen, we're done. We realize that the banking crisis happened and we're not going to try to discount that. We realize credit is getting tighter. We realize that the debt ceiling issue, it might get resolved very quickly, but there's all this stress in the system. And we could all see this. The bond market has been accelerating higher. The dollar is getting stronger. Remember last year, we don't want the dollar to get too strong. It gets problematic. And mortgage, the spreads are getting wider and wider. A great example of what I'm talking about is, the 2023 forecast, bond yields and mortgage rates, right? 7.25 is the peak. And that ties with a 4.25 10-year yield.
That's of your 2023 forecast?
That's a 2023 forecast. We're almost at 7.25, and the 10-year yield today is at 3.82. So we've got a noticeable spread between that, and the spreads were actually getting a little bit better before the banking crisis, and they've just gone reversed right now. So they know all this is happening, and they don't care, right? So instead of saying, I endure, I want a soft landing, they're just go through with it. So, and that makes sense. If you're a 1970s person, you need a job loss recession. There's just no way around it. You cannot have, and when you attack labor, that means the labor supply grows, and that means spending will come down because you're pushing rates high enough to hopefully impact people's spending, and that's people are spending still and people are working still. So in their minds, they don't believe that's a good thing because they believe we're in the early stages of the 1970s inflation, which I 100% disagree with, because if that was the case, the 10-year yield would be north of 5.25, and inflation would be much hotter. than what it is. It's not happening in that regards. And over the next 12 months, the shelter aspect will cool down. Mathematically, just using arithmetic, you're not going to get the 70s inflation for the next 12 months. And they don't care. That's trying to explain to people that they don't care. And that's why, targeting labor to them is their primary goal. And I think that's still to this day, it's confusing for people to think it in that light. But if you do it, if you look at it in that context, then everything makes sense. Everything they've done, since the fall of last year makes 100% sense.
So from your perspective, if they didn't focus on a job loss recession and just let this play out, we would avoid 1970s style inflation anyway.
We cannot get 1970s inflation.
Why is
that is just the labor dynamics back then. The growth in wages and rent and everything took off, and the exact opposite is happening, right? It's not. I know there's a group of people that would say that, well, we have a dying population and wages will have to accelerate. No, wages do not have, the wage spiral premise is not working, right? The wage growth has been falling for 18 months. Go look at the BLS year-over-year data. In a wage spiral 1970s inflation, that goes up. In a 1970s inflation, and the headline inflation data is twice as hotter, 2-3 times hotter than it is right now. That's not happening. We had a supply shock. We had a demand shock. We had a global pandemic. They're all historically inflationary. And now over the next 12 months, it's going to slowly start to come down. So I think they panicked, and they feel like the cover of a job loss recession would validate them as Federal Reserve greats. And this is why I've held to my they will not pivot stance, just by the things they've said, the comments they have made, and also their age, right? These are old people, man. We don't call them old and soul for a reason, right? And even if there was no banking crisis, if there was no crazy stuff happening in the market, okay, you can make somewhat of a case, but that's all happening, and things are getting tighter, right? So trying to convey that to people that I don't think they care about the inflation. Their own forecasts talk about the slowdown in inflation, and they're still pressing along.
Not only do they not care and they want a job loss recession, it seems particularly true that they have said it's okay if all that, if a lot of that pain is on housing. I mean, where we are with interest rates right now, so we're recording this on Friday, May 26th, over 7% mortgage rates, right? I mean, that is killer for the mortgage industry.
Sarah Waller, one of our favorite Fed people, said, well, with the housing rebound, and I literally spit out my coffee. Housing rebound? We're at 10-year lows. We bounced off the biggest collapse in history, and they call that a rebound, and that, oh boy, and I've said this, just like what Neil Kashkari did when he said, oh my God, 6% mortgage rates. That's going to be a problem. People buying homes, having sex, having kids, household formation means you consume, right? My whole, in 2019, I talked about, I can't see a deflationary collapse in America because we have a lot of young people, and young people have sex and they have kids and they create households and they buy stuff. It's different than people like Powell and Waller at their age. They don't do that stuff anymore. So the fear of even mortgage rates getting down to 6% and stabilizing demand made them panic. And then Waller said it again this week, that the rebound in housing. And I was just like, oh my God, they've lost their minds on some of this stuff.
Do they not know anybody in housing?
I honestly would not have any of them. If they worked for me in a firm and they were saying this as an analyst, they're gone. You're fired. How is that a rebound? You could make a very solid case. We had stabilization. Forward-looking data got better, right? But it came off the biggest collapse in home sales history. So the builders are working their magic and paying down rates, right? Imagine if they couldn't do that. So that's just not how, I just think the fear of the 70s has really overtaken them. And And I'm trying to make sense of this for people because people tell me but this is happening. I said, yeah, but all they care about is labor, right? Because we all know the growth rate of inflation is cooling down. It's not re-excelling. It's cooling down, and the arithmetic for you over the next 12 months is good on that front. So again, no pivot until the labor force breaks 323,000 on the 4-week moving average. And my pivot is not rate cuts; it's the language changes. First, they're going to say, okay, well, the labor market is not as strong as we thought anymore. Once you get that, then you start working into other stages of the economy. But we're not there yet.
So looking at your 2023 forecast and where you had 10-year yield and what that meant for mortgage rates, do you now think with what the Fed is doing that you're going to see rates go higher, 10-year yield break that?
Well, it really short term, depending on when this situation with the debt ceiling ends, all bond yields, short, medium, long term, they're all rising together as soon as this episode started to kick up. So it really depends on, do we see a bond rally after this has been fixed? Because in theory, if you're having spending caps and the government is not putting more money into the economy, then you have the student loan debt payments. Those things are actually negatives for the U.S. economy, not positive. So you take those away with everything else is going on, bond yields should see a rally. We're very oversold short term on the bond market, so that can quickly reverse. If that happens, I don't think I'm going to get my 7.25 out there. So technically, if the mortgage-backed spreads didn't get worse and we didn't have this debt ceiling situation, I probably wouldn't be able to get that 7.25. But it just shows you how stressed the mortgage market has been in the last few months, especially in the last few weeks, due to the debt ceiling issue on top of the banking crisis with that.
Okay, well, break that down a little bit more. Explain it like I'm 5. If I'm in the mortgage industry going into June, are mortgage rates going up even past where we are now?
As long as the 10-year yield stays in that channel, you can get 7.5 to even 8% rates. As long as the 10-year yield, yeah, and that's the reality. I know a lot of people thought about the growth rate of inflation falling. Though we created that Gandalf line for a reason. We said, no, we hold that level until labor breaks. Right now, short term, you need to get a little bit more clarity on the debt ceiling issue. If that occurs and bonds rally, you can have the bond yields come back down and mortgage rates come back down. So to me, that's short term, that's the issue. We have not been able to stay above 7% for very long. Technically, we've been here 4 times now. We had a very brief breach the first time. So we'll see how long the duration is. But as long as this drama continues, bond yields, still have a little bit ways to go up higher. And now we talked about this a few weeks ago when people said, well, rates should be lower. And we said, hey, listen, it can get worse, right? Mortgage rates can get worse because the spreads are getting worse. And if bond yields rise, you can get to 7.5 and 8% mortgage rates. But as of now, I think we focus on when the debt ceiling issue gets resolved and see how the market reacts, because the bond market is very oversold short term.
We can only hope that by the time this airs on Memorial Day, that they've come to an agreement on the debt ceiling, and that is no longer a variable.
Yeah, and I think with less money coming into the economy, and then the student loan debt payments start to come about, that in itself is a negative for the economy, and that again pushes us over on the labor market. So though you could look at it in that case of what's going on, the debt ceiling, how it's being discussed and handled, but the payments, the student loan debt payments itself, even though we had the longest economic and job expansion in history with whoever was still paying their student loan payments, we're still doing it. You put that layer onto what is going on currently, and again, that just takes money out of the system because you're just paying a payment and interest. The government owns most of the student loan debt, so they make actual money. Not a lot of people know this, but the government makes billions of dollars on student loan debt because that's their they own the servicing rights. So I remember they were like making $50 to $60 billion a year. So that in itself is not like what we call productive, because the government's not going to really filtrate that interest income out to the economy. So that is a net negative. That's a payment that's taken away from other spending.
Let's switch topics a little bit. Let's talk about pending home sales.
Yeah, pending home sales came in flat month to month. And if you look at what's happened this year, whenever the 10-year yield falls, purchase application data gets better. Whenever they rise, purchase application gets worse. We've been in a channel, right? So there's this tug of war of positive and negative, positive, negative, positive, negative, positive, negative. We've had 10 positive prints this year. We've had now 9 negative prints this year. So there's no kind of breakaway rebound demand. So pending home sales being flat, considering how low sales been, and we've had still more positive prints than negative. We have to start focusing now forward and see how much damage a 7% mortgage market does. And again, forward-looking demand. If we start capturing, we've had back-to-back negative prints in purchase apps. If we keep going with that, then that means the forward-looking data will be negative. It'll catch up to the sales later on, just like it started to get better from November 9th, and the sales levels had a rebound. Here, we have to start focusing in the second half of the year. And again, when rates fall, especially when they get towards 6%, the data gets better. When rates get towards 7% or higher, it gets worse. We want to keep it as simple as that. So the flat pending home sales isn't surprising, because we've had more positive data than negative early on. But now we have to start focusing in the second half of the year, because the seasonality of purchase application data is over with. But I emphasize that there are people out there that filled out an application, they haven't bought a home yet, and rates have now gone up, almost 1% on them. Does that pull them out of the buying data line? And I think that's when rates are this volatile, some of that slippage in the data does occur. It's very hard to track. You just have to assume some people just are not going to pull the trigger on that. And again, it makes it difficult as a seller. We're almost at the end of the seasonality of new listings, and new listings are trending at all-time lows. Do you just pull the plug and go, you know what, I was okay where it was at 6%, but now it's 7%, it could go higher? No, I'm just going to stay at home another year. That's what you don't want to see. That's what we saw last year, and we haven't been able to get any traction on new listings data. So we'll keep. Well, I'll be very interested to see the new listings data the next 3 weeks if rates stay above 7%.
So that was my next question. So we're coming up on the weekend. This is when you get the Altos Research inventory data, which you always tease out on Saturday, and then write the housing market tracker on Sunday, which looks at inventory.
Yeah, and this will be the last. It'll be more of a clean data line this week. You always have to be mindful of any weekly data when there's a holiday, because when there's a holiday, then we're going to have to deal with people just doing their holiday traveling and not participating in home buying and home selling. So for me, it'll be interesting to see if the new listings data has any kind of bigger decline now that rates got above 7%. And one of the things that happened last year is that last year at this time, 2022 data was actually running higher than 2021, and new listings data was showing growth. But when rates spiked the second time in the second half of 2022, that was it. We started to see the seasonal decline, but the seasonal decline also came with year-over-year declines as well. So you always know there's going to be a seasonal decline, but you really didn't want to see that new listings data start to fall in that manner.
Well, and I think we're going to see, because of this, if we could get rates stable towards the middle of the summer or later, then you could see that fall pickup in home selling, right? Because you had a lot of people who seemingly sat out this season.
That's something to think about toward the end of this year. And then also for the 2024 inventory season, right? We've had very, very long delays of getting the seasonal bottom in inventory the last few years because mortgage demand picks up toward the end of the year, and then that filters out into the sales data, which prevents the active listings to grow and the seasonal bottom to get there faster. So it's just when you're working from very low levels of inventory, anything can really move the needle. And we saw that this year, and it's going to be real. I mean, it is going to be so interesting tracking weekly data now for the rest of the year. I mean, again, another big variable change, and you got to go with it, right? Remember, forward-looking data, numbers over people always, right? That's our motto: numbers over people. You take ideological mindset out of the equation, focus on the numbers.
Well, it is Memorial Day weekend. This is not, we don't have a lot of great news for our listeners today, unfortunately, right? Thinking about the Fed just, not caring and going to put pain on, especially on the housing market. But give me 1 minute on why you are still bullish on America, because I know this is a topic.
Well, I mean, first of all, the U.S. is still expanding, right? And you're not seeing credit stress or massive supply growth because people are losing their jobs or anything. I mean, think about this. We just had the biggest inflation shock in recent history. We've had the biggest mortgage rate shock and the biggest short-term interest rate shock, and the unemployment rate's at 3.4%. People are consuming and spending goods, and we have young demographics, right? Because we have a bunch of crazy people on the internet who think we're Japan, and there's only one group of people that think we're Japan, and they're all people who hate the Fed. So yeah, you think of everywhere else around the country, the U.S. economy is holding very firm, right? Because consumer balance sheets are different this time around, and when consumer balance sheets are different, people are employed, they're spending, rates get down to 6%. You can see a demand pick up. So much different kind of housing market than what we saw. But again, we all pay the piper when home prices escalate out of control. And I was reminding people, back in February of 2021, when I wrote the article, we need higher rates, not because this is the housing credit bubble. It's just because inventory is really low and prices can escalate. Back then, we were still dealing with the forbearance crash bros who kept on saying that millions of homes are going to come on the market, even though there wasn't even millions of inventory. So there's something about housing that creates like a sociopathic mindset of people just constantly trolling their lives, and so you have a lot of things going here in the U.S. that are different than other countries. And King dollar again, the dollar's rising, right? That's not that we're not having a collapse of the dollar or anything like that. So considering what's happening in Europe, what's happening in Japan and other places of the world, this is it. This is the show right here. So. The growth rate of inflation falls over time, and we get something back to normal again. But a lot of drama this year, right? There's a lot of drama every year. I mean, 2020, 2021, 2022, 2023. The previous cycle was so boring, but now we're paying for, we're going to have a crazy decade after having a very slow recovery in the previous one.
Listen, I don't even know. When we go back to normal, this podcast is going to feel a lot different. We'll just talk about normal things. We won't have all these weird things.
Yeah. I mean, it's interesting. The previous expansion was so boring, and there wasn't so much volatility in rates, and demand was never exploding higher, and inventory channels were stable, and it's just every week something is up here, but. We love that because we're here to talk about weekly forward-looking data, and that's how it should be done. You just have to be able to explain it for people to make sense out of it all.
Logan, thanks so much for being on. Thanks for your insight, and we will talk to you again after the holiday.
Pleasure to be here, Sarah.